Welcome to Real Estate Live, where your questions get answered. We get to the point with the hot topics everyone is talking about 3 times a week. We go live at 9 a.m. Pacific time on Monday, Wednesday, Friday on YouTube and Facebook. Today's hot topic is all about mortgages, including today's mortgage rates. I'm your host, Andrew Finney with King Realty Group in beautiful Las Vegas, Nevada. After today's hot topic, we'll jump right into the Q&A session, and I envision we'll probably have a very fluid Q&A session with all the comments that'll come in today. Our preferred lender here in Las Vegas, Nevada, Bill Merren with New American Funding, is joining us, and he's going to be giving us these wonderful updates. There's a lot of movement with mortgages right now, and a lot of questions I've been noticing on the YouTube channel coming in from you. So if you happen to catch us live today, please ask your questions. Let's make sure we get those questions answered for you. And without further ado, let's go ahead and bring Bill Merren up. Good morning, Mr. Bill.
Good morning, Andrew. What's going on, buddy?
Wow, it's going, my friend. I'm starting to get a little bit bushy and shaggy on the backside of my neck. So it's a good thing these earbuds, this big old headset keeps that from showing. I still haven't got the courage just yet to make the leap and break out the razor.
Do the COVID cut, man. You haven't got the.
Hey, if it gets bad enough, I'll just buzz it and go back to like boot camp look, right? It is what it is. But hey, why don't we go ahead and lead in with like what's going on with today's mortgage rates, please?
Yeah, so as we were talking about, Andrew, before we started, man, it's a big week this week in the mortgage world with mortgage rates because it's what we call Jobs Week. So Jobs Week is when the unemployment data comes out, and unemployment data can have a direct impact on mortgage rates, which can trickle down to your mortgage lender and their interest rates. So it's something definitely to watch. This Wednesday is the ADP report that's coming out, which is going to say what they are saying that the unemployment rate is. And then on Friday, another massive report for the jobs report is going to be from BLS, or Bureau of Labor Statistics. So when those reports come out, we see what's going on now. We see what's going on in the world. We see what's going on in the economy. We, everywhere we look, we see people talking about, people being laid off, jobs being terminated, furloughed, that kind of stuff, and people filing for unemployment. So we kind of are thinking and anticipating that unemployment rate is going to be higher as we continue going through this. Now, these numbers and this data is going to be for the month of April, but this data at the same time is coming from the 12th of April, and they kind of project it out for the rest of that month. So we're thinking it's going to be somewhere around 16%, maybe a little bit higher, but that's about where we're at. Now, historically, typically, bad news, and that is bad news. Unemployment data being that high is typically good news for interest rates. So again, that could definitely help out with some interest rates. It might lower them maybe a little bit if somebody's kind of on the fence about buying.
So yeah, it's pretty interesting that you'd have on one side of that, really bad news. If the unemployment rate is higher, it can actually lower the interest rate. And my guess is, and please correct me if I'm mistaken, that's kind of to stimulate the economy and the housing and mortgage markets at large to get lower interest rates to anyone that can qualify. And with the mortgage news and the different things that are happening right now, one of the curiosities that I'm watching is just how tight a lot of lenders are getting across these United States with like their max or the minimum FICO scores and minimum down payment amounts. Have you noticed any changes with what's happening there as far as minimum FICOs? Are they starting to relax a little bit, or are they just getting tighter?
They've kind of gotten tighter. I mean, every lender is going to be different. A lot of the depositories or the big banks, they've gotten very tight. I have some good friends. I won't mention the names of the banks, but they're the big banks. They're loan officers or other people that work there, and they've actually been referring me deals because they just can't get it done. They can't do it. So, the guidelines, the credit scores have increased. The minimum credit score requirements have increased 660. A couple of the big banks, I heard, was like 680 and even 700, and requiring as high as 20% down to do a transaction. That just wipes out a huge segment of home buyers, as you know. So definitely something to watch. And then the big thing is just keeping an eye on the employment, probability of continued employment, because some lenders I've seen just adding, and it, by all means, I mean, it makes sense. I mean, they're adding guidelines additional on top of already some of their additional guidelines that they require, just wanting to make sure that the individual is going to be employed, and we're not going to be putting them in a bad position as a lender to close on the house and all of a sudden they get laid off.
Right.
So definitely something to keep an eye on.
Well, I'm glad that you mentioned that, because then that goes into like kind of our mortgage news and something that we were talking about a moment ago. 16% present unemployment. My curiosity, and I still haven't been able to find it, and maybe you can help with that if you have access to it on the lending side of things, which is how many people are presently considered unemployed that are in reality furloughed, that are going to get their jobs back. And I think that's really important to take in context. But I've noticed a trend over the past 10 days, frankly, and probably more in the last 5 days, with different people that I've spoken with locally, or people that have reached out to us on andrewfinneyteam.com about potentially buying a home that are presently unemployed or furloughed. And that trend is actually very disturbing to me in a way. And what I'm hearing a lot is, hey, Andrew, I don't want to go back to work anytime before I have to. And I said, well, why is that? Is it because of what's happening with COVID? Are you afraid? I mean, what's the situation? And they said, no, Andrew, I'm making a lot more money on unemployment and the stimulus checks and blah, blah, blah. And I'm thinking, that's not good, because at the end of the day, if you're not being a productive citizen and working for your income and stuff, you're putting more strain onto the system that causes a bigger economic issue for all of us when you start calculating that out across millions of people. And I was thinking to myself, why is it like, to me, I know that you and I have different beliefs in different ways, but we've always had a very strong relationship based upon integrity and respect for each other and our friendship, right? But I am a firm believer there should be a social safety net called welfare and unemployment and stuff like that. But I don't believe it should be considered a way of life. And this is where I get bothered whenever I'm like, why are you making more money on unemployment than you did when you were gainfully employed? Why is that allowed? And the reason it's disturbing, because I'm like, okay, let's say that, a good 80% or more, which is probably very reasonable, and please correct me if I'm backtrack crazy here, are probably furloughed. And when their employers are allowed to return them to work, then they should be going back to work. But if you have an employee that was furloughed that is resistant to going back to work because of the benefits, now you really do risk getting fired.
Yeah. So that's Andrew, that comes into like something we could talk for hours about this, but that's something that I'm extremely passionate about when it comes to people. Just kind of, man, if you want to do great things in life, if you want to accomplish great things, man, go for it. Like, you have an opportunity to do that. However, if you're going to be a leech and you're going to try to take advantage of the system, you get what you deserve when it comes back and kicks you in the butt, because it will catch up with you. I mean, at some point it will. I do, like you mentioned, we have some very different beliefs, but we respect each other. Like you're my brother, right? Like, we respect each other's beliefs. We treat each other with mutual respect. But I do agree with you in you mentioned like the social safety nets and that kind of stuff. When it comes to when somebody loses a job, that cannot get a job, they should have some type of unemployment to make sure that they're okay, which should be a temporary situation. It should not be long-term. I think 2 years is way too long, unless somebody's got some type of medical condition or something like that. If somebody can go back to work, by all means, man. I actually met a guy yesterday at Walgreens who was saying the same thing, to where he was like, I'm working over here. I'm a manager at this casino. He goes, but man, I'll ride this out as long as I can, because, I'm making like $400 more a month, not working, collecting unemployment. That wasn't work. And I'm like, well, what's going to happen, dude, if your job is no longer there, or if you want to get hired back, but now you're collecting unemployment, you don't want to go back, and then you get fired and you don't go back. I mean, it's just, there's so many things that can just go into, that it's just not something people should do. And it goes into all these different aspects of credit cards, auto payments, mortgage forbearance, all these different things, to where student loans are a bit of a different animal, because of, and again, that's a whole nother topic about something that, people are, it's, if you can afford to make the payments, make the payments. Don't try to do a forbearance on your, on your payments that are due, because they will catch up with you. It's not going to be something you're going to be able to scam the system on forever.
And I appreciate your candidness there, or your honesty rather. I'd hate to say candid, because I had a great, wonderful past client tell me, Andrew, if you tell someone they're being candid, it's actually not a good thing. And I said, well, I just always thought it was meant a very nice word for honest, but let's just rephrase that and say honest, right? I appreciate your honesty, because we're always stronger and better together than we are not. It's something that I keep saying, and we got to go beyond fear that false evidence appearing real. And we have to come together, not only in times of need, but stay together through the process of moving forward, right?
Yeah.
And the reason I keep reiterating these messages so much is because if we don't take care of each other and we don't take care of ourselves, everything falls apart. Our society in general, our economics across this world are actually extremely delicate. And if you start saying, hey, I'm trying to game the system, I'm in it to win it and only for me, and what can I get? What can I get? What can I get? Then that's playing what's called a finite game in the words of Simon Sinek, right? As opposed to playing the infinite game, which is a mindset of, hey, let's come together. We're all in this together and we need to come together to make things work better. So it goes back to the conversations we were having about mortgage forbearance, which is something we need to touch on here in a moment, about before even anybody was really talking about the guidelines that were going to be pushed out. And we've been very consistent in saying, if you can pay your mortgage, pay your mortgage. Because at the end of the day, there's going to be a piper to be paid one way or another. And you were telling me some very, in my opinion, some disturbing news about mortgage forbearance. So I do want to go into what is going on right now with the current mortgage forbearance trends that you are noticing as a loan officer.
Yeah. So, Andrew, I think it's important for everybody to understand what mortgage forbearance is that's out there watching this, whether it's live or whether it's sometime in the future. Mortgage forbearance is when you can no longer afford to make your mortgage payment due to some type of unforeseen circumstance, to where you can get some type of mortgage where you can not make your payment for potentially a short or maybe a little bit longer of a period of time, but that will have to be paid back at some point. So it does not mean that you're going to skip mortgage payments and never have to pay them back. It does not mean that you automatically qualify because of the pandemic. It doesn't even mean that you automatically qualify because you've been laid off. So it is something to just be in communication with your mortgage lender about. And make sure that they understand kind of what your situation is. So that being said, going into what I found out this morning was what we're being told, and some of the guys that I follow and what they're seeing is mortgage forbearance.
Did you lose connection?
We were that it might be about 4 to 5%.
Could you repeat that? You phased out on us for a moment.
Oh,
you phased out right around the section that said, hey, some of the guys I follow, what we're hearing is, and then it phased.
So what we're hearing is, well, what we were thinking was that it was around 4 to 5%, 4 to 5% of mortgages out there across the country, people that own homes that have mortgages on them, 4 to 5% were going to be in mortgage forbearance. But currently we're looking at about 15+% of mortgages that are out there currently being in a forbearance status. So that right there is something just to keep in mind, guys. It's not as, because I talked to so many people about this. Talked to one individual over the weekend that he needs it, like without a doubt, he needs to do it. Some people don't though. And the thing to keep in mind is nobody knows exactly how this is going to play out. One thing that we have heard recently is if you do mortgage forbearance and you go through it the right way because you need it, and you come out of the mortgage forbearance, you enter into the program or whatever that lender is going to require you to do, you're not going to be eligible. Again, this is what we've heard is probably going to happen. It's not 100% concrete set in stone yet, but you may not be able to do any type of mortgage for up to 12 months, which is freaking huge because there is so much opportunity out there right now with a potential refinance at just literally just historic low rates. The real estate market is great. Being able to buy a home with a historically low rate. There's a lot of opportunity out there. And if you try to take advantage of that system, or maybe you have some money and you can make your mortgage payment, it's a good idea to consider your options, because that mortgage forbearance is not going to be as sexy as you might think it is.
Yeah, and I agree with you. Now, I have seen a lot of different information out there that it sounds like, and I'd like to get the straight scoop on this, and I know it's a little bit difficult when things are moving, but it looks like things are starting to gel into a form of a foundation for guidelines and how these forbearances are going to work. I've seen a lot of stuff out there that are saying they're actually going to end up allowing initially a 2-month forbearance and up to 6 months or a little bit longer if necessary. But if longer, they want to start going into loan modification. And the reason I think this conversation is so important, because on the flip side of this, you have a lot of fear mongers out there, frankly, that are clickbaiting the heck out of people and preying on people saying, hey, foreclosures are going to go through the roof. And it's just not the case, because if you have a mortgage forbearance vehicle in here that is going to prevent that from happening, ideally for those people that need it. And remember, that's the key word that we keep using, the ones that really need it. That should be a program they're able to use. But then you move forward and you say, okay, Let's take a look at real estate appreciation over these past, decade, right? And unless you bought a house in the last 12 to 18 months in the majority of the United States, you likely have equity position in your property and could sell in a worst case situation, avoid defaults and everything else. But even before that, you have the option of this thing, a loan modification, do you not?
Correct. Yeah.
So we go from a forbearance to a loan modification to, well, if you have equity in your property, worst case situation, you sell it, you cash out, you take the equity with you, regroup and pivot in life and flex and be flexible and make a well-informed decision that's right for you at that time, which again would keep actual foreclosures down. But the reason that I think this forbearance trend is disturbing is because we need to know, again, going back to percentages with like unemployment, how many people are furloughed and how many people are going to return to work, and then hitting the reality. Remember the three-sided coin here. You got an extreme on both sides, but the truth is in the middle. The truth is in the middle also that we also as people have to take responsibility and own our behavior, our thoughts, our actions, and what we do. And if people are saying, I don't want to go back to work because I'm making too much money on unemployment, then you're really in jeopardy of losing your job. Because if I was your employer and that's what I found out, the moment I could fire you, I fired you, because unemployment benefits cost money. And if you're not being a productive citizen to that corporation, then at that point, the company doesn't have the money to keep paying you because there is nobody working that job, or there's fewer people working that job in a time of need. Hence why you were gainfully employed by that employer. So if that was a situation that was on my watch, as much as I believe in bringing as much love, joy, and hope to people, and I do, there's a difference between being someone's fool and having a kind heart full of love to help people. Because if somebody truly wants to help, then they also help themselves and they do the best that they can. So you got to own that action and you got to own that thought process. And that's where I think too much of the conversation is not directed right now, which is about personal accountability. And I know it's some people will spend millions of dollars and make people multimillionaires that are really robust people like Tony Robbins, Brendon Burchard, and they really are preaching personal accountability. But then you get somebody like me that's probably not quite as eloquent in speech or well known, and then people hate me for it. But the truth is the truth. And no matter what, the truth is the truth. And you got to be personally accountable if you want to succeed. And you said that just earlier on in today's stream as well, about being responsible with the decisions you make. This isn't a world in which you can game and keep trying to play and win. If you want to do well, you have to look out for your neighbor, you have to look out for yourself, and you have to look out for your family. And when everybody together is doing that, that's where you enter that moving beyond fear movement. And that's where you enter the stronger and better together phase. Anyways, I can really digress on, very deep passions of mine about helping people grow personally and professionally. And it's probably the biggest passion that I have is trying to help people essentially make sense of life. But this is a real estate channel, and this is a real estate live stream. So let's turn over to some of the comments that we have coming in so we can get on point, if that's okay. Okay, so let's go over here. Claudia, thank you so much. I noticed that you were on and sending a message in before we went live. I wanted to say thank you for that. It's really exciting to me to see that. Same thing with April. She did that. Good morning. It was great to see you here again, as always. Wow. Meseret was on very quick saying, good morning. Your positivity gives us hope. Thank you. That's what this is about, is positivity, but it's also about realism and recognizing what I just said a moment ago. So I don't want to digress. Let's go into Claudia here that says, hey, I did a cash out refinance. I closed on April 23rd. The disbursement was made on April 28th. And on May 1st, a person from the title company called me and said they made a mistake in the closing disclosure numbers. They put the wrong amount. They want me to send them $3,918 that was short. It was their mistake. Who was at fault here?
Wow. So that's a big one.
That is a big one.
I am not a real estate attorney by any means. That's not what I do. But what I would say is your lender's probably going to have to eat that. You've already closed. It was on the closing disclosure. They made a mistake. Honestly, sucks for them. They're going to probably have to eat that. Now, I don't know what the mistake was. Depends on what the mistake was. If it was something that was your fault, something that maybe you did, it might be on you. More than likely, it was their fault. More than likely, they made a mistake on some type of number. I'm not sure what it was, because that's a really big amount. You should not have to come in with that additional cash to close once you've already closed. Now, again, I don't know your exact situation. If you want to maybe reach out to me kind of offline, Andrew's got my information down below in the description. I'd love to maybe chat with you a little bit more about it. But yeah, that's a big dollar amount. I don't believe that's going to be something that you're going to be required to do. It's probably they're just going to have to eat it.
Mm-hmm. And Claudia, here again, right here on the screen is his actual website, billmerrenloans.com. Direct number, mobile number, email right there if you want to take them up on contacting them off to the side to try to figure that out. We definitely want to make sure you're taken care of, my friend. So thank you.
Mistakes, sorry, Andrew and Claudia, mistakes do happen, right? I mean, it's happened with me before. I've made a mistake on transactions to where I'm gonna have to come in with $500, $600, $800 because it was my honest mistake, and I do that. But you're talking $3,900. I would definitely reach out to your lender and find out what was going on.
That's a bigger mistake than I think I've ever heard of.
It's
practice. That's a big one. Like you said, a few $100s here or there, and then what ends up happening is still the buyer's not penalized. You and I, depending on whose mistake it was, will make sure it's right by the buyer and essentially eat it. And pay that cost if it was our mistake. That's something that we do, going back to integrity and practice. Claudia, please don't be afraid to reach out to Bill directly and get to the bottom of that. Morgan, hey Morgan, thanks so much for joining us today. Morgan says, I have a question about renovation mortgages. And Bill, by the way, renovation mortgages, something called home style was coming up a lot last Friday. If you can touch on this about renovation mortgages, home style. Right here, that Morgan is saying the 203K Fannie Mae home style. I've heard that many lenders are no longer doing them. Is that true?
So yeah, again, this just goes in line with the trend right now of a lot of lenders tightening up things they're no longer doing. I'm not sure on the home style with my company. I have not done many of them. I do know that we are still doing 203Ks. So a 203K, for anybody that doesn't know, that's going to be an FHA kind of renovation type loan, and a home style is going to be on the conventional side of things. So there's two different types of loan programs. So yeah, I do know for a fact there is a couple of lenders, even smaller local lenders here in Vegas, have stopped doing them altogether. But again, I know that I am still doing 203Ks, not sure about home style. So if you are working with someone, if you are not in Las Vegas, go ahead and reach out to them, see what they've got going on. If you want, just reach out to my information in that description below. And I do have partners across the country, and I believe the lower 48 that we can help out with. So if you're in another state, you're not in Vegas, reach out to me. I can see what your situation is and get connected with someone who can.
All right. Thank you. Hey, Morgan, I hope that helps out with your question there. Now, Bill, maybe, remember my ears got busted out when I was in the Marine Corps and everything else, but right. I heard you say 203K was for FHA.
Correct. Yep.
Okay. Home styles for conventional.
Yep.
Does VA have an option now that you're talking about renovation loans? Is it called something different than a 203K?
There's a couple of different things when it comes to VA renovation. I've never actually done them. I've done energy efficient, though, is to where through a closing, a veteran can actually add in the cost of doing energy efficient improvements, better insulating windows, updating furnaces, things like that, that yes, we can get done through VA.
So with that, when you say that, now it starts triggering things in my head. So would there be something called like a VA? I know you love it whenever that happens. But is there something called like a VA rehab loan, like where they can rehabilitate a property for, let's say, medical needs if they were a disabled veteran? And is that like something that would operate similar to the 203Ks, or just about bringing it up to current disability standards for that veteran specific medical needs?
Yeah, so that's going to be related directly to the veteran, and not a lot of lenders do them. So you'll want to reach out to one of the local lenders out there and see if anybody can guide you down that path. I don't particularly do them. I've done one in 14 years, but it is something that's cool through the VA to where if you do need to do them, it can be done. It's a bit of a tedious process, but it is something that is available for veterans, and it does have to tailor to a disabled veteran who has some type of need that needs to be filled.
Okay. So thank you for the heads up on that. I know, again, you love it whenever I just like, hey, Bill, Birdie just flew on my shoulder. I have a question, right? So Lindora, hey, thank you for being here again, Lindora. It's great to hear from you and know that you're here. Lindora says, good morning, Andrew and Bill. Happy Monday. Real estate education. Yay. Learning, learning, learning. Looking forward to purchasing a home soon. Good on you. If you're watching this, Lindora, as you are, then you are going to be one heck of a savvy home buyer by the time you get ready to purchase, and you're going to know a lot. So good on you for that. Pocho Perez says, good morning. This is the gentleman that had asked us Friday, and I called you and said, hey, Bill, what's going on with this? So this is a good thing that came up. So Pocho, thank you for joining us back today, because Bill and I did have this conversation. So for everybody else, if you're just tuning in, by the way, thank you for joining us. Good morning. How is the CAFRS report being updated? While I am now in underwriting, the CAFRS is still on my report. I have paid my student loan since May 2019 on time, and this report was not on my account in February 2020. Now, since last Monday, it is back. CARES Act activated the report as per the Department of Education.
That sucks. So it's CAVRS. So CAVRS is going to be something, Andrew, that when you're doing an FHA loan, CAVRS is run to make sure you're not delinquent on any federal debt that we don't know about, making sure no federal debt was paid back late, things like that. Pocho, in that aspect, I mean, if CAVRS is reporting that your student loans are delinquent, I would reach out to that lender and find out what they can do to maybe get that updated. If there's anything you can provide to them to show that it is in current status, that you're not currently in default, they might be able to get around that. You might actually have to get it updated with the Department of Education to make sure that you're not currently in default. So, and then for anybody that's watching this too about CAVRS is going to also show if you ever short sale, if you ever have any type of foreclosure, anything like that on any type of federal loan, when you go and apply for a new one, we always pull a CAVRS, and it's not done until you're actually in the process. But CAVRS is pulled to make sure that we can see not only when your home actually sold, because it's important when your home sells, but what we're actually looking for is when FHA is paid back the money that they were owed. That's when that date starts, and that's when we see it on CAVRS. So Pocho, I hope that helps, man.
Hey, so Bill, just to touch on something you said, just for the point of clarity, you said work with the lender. I'm assuming that whenever I hear this in context of what you're saying, he should be going to the student loan lender to see if that's something that can get corrected, or are you referring to working with the mortgage officer?
Yeah, because obviously he's already working with the lender because they pulled a CAVRS. So I would go directly to that lender and find out, hey, what can I do to fix this? Pocho, I would go directly to your loan officer. Maybe your LO doesn't know what's up, which is very common. Processors are usually on point when it comes to this stuff. Mm-hmm. Call your loan processor that you've hopefully been in communication with, and they might have an option for you to get that straight.
So the other thing that comes to mind, and I appreciate that very deep dive into CAVRS right there, that's very helpful. It reminds me of, on the real estate side of things, what's called like a CLUE report. A CLUE, a CLUE report, which is a comprehensive loss and underwriting exchange showing any time an insurance claim has been filed against a specific property. Easiest way to explain this for everybody to understand is to think of like when you hear Carfax, right? Anytime that a car was, an insurance claim was ran against the car and there was a claim made to help fix it or whatever the situation may be, there's such a thing with a home and through the insurance exchange as well. It's called a CLUE report. And it's a comprehensive loss and underwriting exchange. But I just thought when you started talking about CAVRS, the deep dive into short sales, foreclosures, student loan debts, any federally issued loans and stuff, first thing that came to mind was like a CLUE report. So education opportunity there. So thank you for that. Lindora Brown says, thank you, Andrew and Bill. Lynn Willard says, good afternoon. Lynn Ann, thank you so much for being here with us. Steve Estrolato says, wow, 15% and forbearance. Where are there pockets in the U.S. with the most? Do you
don't know that? Yeah, I don't know the answer to that question. I know it's across the country. We're seeing relatively similar numbers. I don't know what areas will be worse yet. I mean, that data is going to be coming out. It's still relatively new. Like I said, that data was coming from the beginning of April. So between April 12th and now, a lot of stuff has changed. A lot of it's gotten worse. So look out for another update the first week of June with what's actually going on, what happened from the middle of April through the middle of May.
You're talking about with the job reports there, or what are we referring to specifically?
Both forbearance and jobs reports.
So the forbearance and job report coming out again end of May, early June? Yeah. Okay, perfect. So Claudia said, hey, they put the wrong payoff information, and that was what it was. Remember back to what she was saying with the closing disclosure being wrong. Now the title officer's coming after her for $3,918. And everyone, if you're just joining us not live or after the fact, thank you for being here. Claudia was asking some questions. And by the way, if you watch this After we're live, I always leave the live chat replay on so you can filter through the questions that you want to hear the answers to. So Bill, without further ado, does that make a difference when you start hearing that information in relation to her situation with the closing disclosure?
So it's that is a lender mistake. That was either the lender or the title company. That is going to be on them. I'm not a real estate attorney, right? So what I would do, Claudia, that's a big dollar amount. I would find a local real estate attorney and I would contact them and see what your options are, because that's a bad mistake. That's on the lender's side. They should be the ones to have to remedy that, in my opinion. But again, I'm not a real estate attorney. Do not just let this go because your current mortgage that was just refinanced to be paid off is not going to be paid off in full, and you could have a mortgage default. So not good at all. I would contact a local real estate attorney immediately.
Okay. Thank you for that, Claudia. And please definitely take that for action as soon as possible, if not today. Carmina Calva, thank you for joining us. Carmina says, good morning, Andrew and Bill. Thank you for keeping us informed and have a great day. My friend, definitely appreciate your support and your positive mojo. And we wish you a fantastic day as well. Ben Provis says, good morning, guys. Could you or Bill explain the cost of locking rates, please? Like the difference between 60, 45, 30-day locks, etc. Thank you. Bill?
Yeah, awesome question. So when it comes to locking in an interest rate, I advise my clients, because I watch something that gives me insight and kind of insider intelligence, and people that all they do is follow mortgage rates, and they predict based on jobs reports and things going on in the economy, kind of what's going to happen. We get recommendations to float or to lock. I always recommend to my clients, if you are within 30 days of closing and you are happy with what the rate is that you're being quoted now, lock your rate, because something can change that can totally just mess everything up. So if you're within 30 days, I believe, and it's just my practice of doing this for 14 years because I've seen too many deals blow up. I have stepped in to save too many deals, and I've seen too many families get in bad situations. If you're within 30 days of closing, please lock your loan. 20 to 30 days out, you should definitely be locked by day 20. Now 30, 45, and 60-day locks. If you are in a situation to where your debt to income ratio is super tight, and a small fluctuation in interest rate going up could drastically affect your ability to close, it might be a good idea to do a 45 or a 60-day lock on your transaction. Now, if you do a longer lock, it's going to be a higher cost, like you had mentioned, Ben, of doing the loan. So that might mean a 30-day lock, say, just for example's sake, I'm not saying this will be your rate, but say your rate was 3.5%. 30-day lock, no points. A 45-day lock, you should still be able to get that 3.5%, but now it might be a quarter cost. A 60-day lock, that same 3.5% might be, a half a point cost or 3/4 of a point cost, because the longer lock period that you have on that loan, you're going to have an increase with the cost of that lock, because the lender is securing that lock for a longer period of time before they close. So that is very common for that to happen. We've seen recently, since this whole COVID pandemic has been going on, that the cost of extending, doing a longer rate lock is more expensive than it has been, just due to the market volatility. So very common. A great question, man.
Mm-hmm. Thank you for that update. And Ben, I hope that's helpful to your question there. So the Too Blessed, thank you for joining us, says, during this period, what is the best rate that one of your clients have gotten for FHA, and what was their credit score, and would you recommend a rescore if your credit score has gone up since approval?
So FHA now, been doing a lot of VA recently. FHA, we had a client get 3.25, and they were paying, I believe, a point. Again, I'm not sitting here looking at this information in front of me, but 3.25, I believe they might have been paying about a point. That was with a good credit score. They had, I believe, over a 680. Now, if you were in a position of closing on a loan, and you might be right there, because when it comes to interest rates, there is tiers of credit. Tiers of credit meaning from a 620 to a 640, your rate is X. From a 640 to a 680, your rate is Y. From a 680 to a set. So the higher your credit is in those different tiers, the better your rate could potentially be. So if you have something as simple as like a credit card that's maybe got like, almost maxed out, and if you've got the funds available, communicate with your lender. Don't just go do it. If you want help doing it, I can walk you through it. If we close on your transaction, I do it all the time, where you can actually lower your balance on the credit card to 30% or less. We actually have simulators that we can run that can tell us specifically what cards to pay down, what balances to have. And you can actually get an updated credit score within a week. So super cool to do that. Now just be careful though, because there's some loan programs out there that don't allow a rescore. A lot of down payment assistance programs, all those kinds of things don't allow it. Jumbo doesn't allow it. FHA, if it's just a regular FHA loan, you should be fine.
So on the rescore, what I heard you say was a lot of loan programs will allow it, but specifically when it comes to down payment assistance, there's a lot that don't. Is that accurate?
Yeah, there's a lot of down payment assistance programs that do not allow it, but there's also some lenders, if they don't service their own loans, meaning when you close with them, if you're not going to be making your payment with them, they may not allow a rescore. So you just want to double check with that lender. Very good. Thank you for that. Hugo G says, good afternoon. Based on the information provided by the media, USA will have 56 million people unemployed in the near future. What will be the impact on real estate? First, Hugo, I don't believe that number, but go ahead and jump on it. Yeah. So I just wanted to Andrew, you got the data. You want to talk about that stuff, but I want to talk about something real quick. Please. When it comes to the media, I was listening to a very, very, very intelligent guy speak this weekend, and he was talking about fear pushers versus faith pushers. And there's a lot out there that are fear pushers because it gets them ratings, it gets them whatever the reason is that they're doing it, gets them some type of benefit. And that does, by so many people being influenced with all that coming in to their brains every day before they go to bed or during the day, it causes us to like, that's what we put out. So because of all these fear pushers putting that information out there that may or may not be correct, it's just causing a tainted mindset. I don't believe that's true. Like worrying about things you can't control is like the fertilizer for weeds in your freaking brain. It makes no sense, right? So what I would just say is when it comes to that stuff, take it with a grain of salt. Reach out to some people who are kind of in the know when it comes to anything you're seeing on the news and get some actual data and some facts. So Andrew, that was just, I had to say that because I appreciate you. I appreciate that. And I actually really like, and who was the gentleman that you were listening to for context purposes that was talking about fear pusher versus a faith pusher? John Maxwell, one of the number one leadership authors in the world. Yeah, I have some of his books too. So there you go. That explains a lot. So the reason that I say that is, I always like to say, hey, maybe if I was, like a really beautiful man or woman or something, and maybe if, I used fear, which doesn't sit well with me, so I don't, because fear is false evidence appearing real. I don't clickbait. So when you say the comment, fear pusher versus faith pushers, I believe that the whole premise of why I wanted to do the live stream and why we started talking about this was to give people transparency and what's happening in the process, because we are the people, at least in real estate and mortgage, not that we're the end all to real estate or mortgages, mind you, but we are in the know. We are constantly doing this day in and day out, and we know what's real and what's not. 50 to 60 million people going unemployed in the near future, Hugo, is the most ostentatious, astounding, and astronomical projection I have heard yet. I've heard numbers that say, 20, 30 million people. We're at 26, 30 million people who are unemployed. But again, Hugo, when you're asking me about the impact on real estate in specific, you got to get real with how many of these people are furloughed. And that's so important for some reason, people just keep losing that context. But without it, you don't have an appropriate paradigm to view what's really happening. So we shall see what ends up happening, Hugo, but long-term unemployment, absolutely not. Definitely don't see, even if it were to spike like that, let's just play devil's advocate here. I definitely don't see it staying there for very long. And that has to do with all of the furloughs yeah, actually, that was correct. The furloughed employees getting ready to go back to work as the states begin to reopen. In last Friday's video, I provided some links to the U.S. interactive maps based upon the governor's projections for each state. Matter of fact, that you could go to your specific state and find out when the governor was planning to release in phases or in whole of putting people back to work in the economy again. Just
a heads up and for reference. If it's something that's helpful to you, then, just let me know, guys and gals, and I'll put it in today's video as well. Claudia said, thank you, guys. I'm glad we were able to help you, Claudia. Elena says, good morning. I joined late, but I am wanting to hear from Bill about custom build construction loans, please.
Custom build construction loans. So that is actually been a really hot topic, not in the last 2 months, but right before this whole thing started to go down, because a lot of people were wanting to do them. So custom new construction loans is going to be what's called a construction to perm. So depending on the lender and the lender that you're working with right now, those guidelines have drastically changed the last 2 months, because before we were able to allow you to purchase the land with loans and then build on them and all that. But right now that's not going on. I don't know of any lender here locally that's doing land loans without massive down payments. So the construction loan side of that, depending on how you do it, construction loans are done in phases. Every lender is going to have their different way of doing it, to where you're not going to be making your mortgage payment on that until the loan is completed and finished. But it does go, typically it goes in phases, and you want to make sure that you're working with a lender who's got a lot of experience doing the construction loans, because they're very intensive with all the different things that come into play with them.
You hear me, even though this is live and it's recorded afterwards, and here I am jotting down notes as you're talking. I can't help it. It's the nerd in me. I'm just always jotting things down. These are great questions today, and I'm super glad that we have you here with us for these today. Kenneth says, what are the rates on average currently for a VA home loan?
I'm locking them a lot at below 3%, 2.75, 2.8. What that is with a point, right? So depending on where you're at, depending on where we can catch the market, depending on your credit score, it just depends. VA interest rate reduction loans, more commonly referred to as VA IRRRLs, and all of us veterans out there who have a VA loan, you know that we get all these things in the mail that look like they come from our mortgage lender, but they're actually not. It's other lenders trying to appear in a way to make you open it and read it, and that's what that is. That's a VA interest rate reduction loan. If anybody wants help with that across the country, definitely reach out to me. I can help you with that. My team can help you with that. But when it comes to purchases, it depends on your credit score, and it depends on if you're doing a conforming loan amount, under the 510, 350 mark, or whether you're doing jumbo. So if you're doing a traditional purchase, your credit score is 680 and above, you should be right around 3%, maybe 3.25%.
All right, that's good stuff. Thanks, Bill. Tim, hey, Tim, thank you for joining us, and thank you for being a new follower of the channel. It really means a lot to us, and I'm super glad that you've joined our community. I always believe that your vibe attracts your tribe, so I'm glad that you're part of our tribe, and we share the same vibe. So he says, hi, guys, new follower to the channel. I'm positioning to buy a home and hearing talk of a housing market crash based on potential stimulus, inflation, and unemployment. Are you guys on board to buy soon or wait? And by the way, I'm also local to Las Vegas, which is great. So please definitely feel free to use the information in the descriptions and reach out to me and Bill directly, Tim. With that said, let's go back to the point. And I know, Bill, you got to hop off here in a couple minutes, but why don't you go ahead and take a stab, and then I will jump on thereafter when you need to adjourn.
So there is a lot of people talking about the market crashing when it comes to the real estate market because of what happened in 2008. But there's so many different factors when it comes to what's currently going on. I mean, there's a lot of people who are hurting right now for sure. I mean, just with what's going on here in Vegas and the different casinos, but that's not going to cause the market to just completely bottom out and crash, because there's so many other stabilization factors that are going on. In my opinion, I don't believe so. I believe right now that rates are really good. Could they get better? They might get a little bit better, not much, but prices I don't believe are going to crash. Could they come down 2-3%? Maybe, but I don't think that they're going to drop like what people are thinking, like a 25% reduction in prices across the market. It's just not going to happen.
And look, I completely agree with you on that, Bill. And I've had a lot of conversations with people about foreclosures. In fact, I had a gentleman just 3 of these calls just over the weekend about, hey, Andrew, I want to buy a foreclosure. And I said, well, what's significant to you about a foreclosure? Well, I want a really good deal. Okay, what does that look like to you? and they can't define it. That's problem number one. Problem number two, as I shared with them, I said presently in the Las Vegas marketplace, and this is an accurate stat, I haven't checked it today, but it was very accurate just as of Saturday, there are only 48 foreclosure properties available for sale in the entirety of Clark County, which is over 2 million people. I mean, that's a lot. So when you start looking at that, there's only 48 and there's about 5,400 homes available for sale. We're well less than 1%. So when I try to share with them, even if the foreclosure rate jumped fivefold and you'd be at 5%. Consider whenever I got into real estate in late 2013, it seemed like over 55% of our market was foreclosure, short sales, auction properties, just distressed property sales at large. So it's very important to put into historical context what's going on here. And when we're reviewing that, it goes back to something Bill and I were talking about earlier about, okay, we got this mortgage forbearance vehicle. Since 2008's collapse, lenders had tightened guidelines for income, asset, credit, and employment verification, debt to income ratios. The buyers actually need to have the ability to repay said loan and not exceed the maximum debt to income ratios. All of these things are vastly different. And that's why I don't believe we're going to see all of these foreclosures. And then you layer it in with mortgage forbearance. Then, okay, if that process starts getting dicey, then you have this other process called loan modification. If that process starts going this way or that, then if you have equity in your home, you sell it and you cash it out and you move forward in life. Bill, I don't want to, I know you'll probably need to jump off, right? I just saw the time. Sorry.
Just a couple minutes. I agree with you, man, 100%. Because I weathered that storm, man. I went through it. I was in the industry at that point. It's actually when I got started. And it was crazy. I mean, I didn't know any better because that's when I started. I thought it was always that way. I thought it was always going to be that way. But we were literally doing loans for people that we had no idea what their income was because we weren't required to verify it. We had no idea what their assets were because they had a 700 FICO score. They were putting no money down because they were doing 80/20s. It was crazy. And that's not been going on. People have been, lenders have required that people prove that they can make their payments. We learned from our mistakes of that time. We truly did. We put guidelines in place. Lenders put guidelines in place to weather that storm and to not go through that same thing that we went through before. So, Andrew, great points, man.
Hey, thank you for that. And Tim, I'll probably jump on that again here in a moment. But before Bill does have to go off, there's another long question that I don't have the answer for with the fluidity of what's happening right now. Paul Chris, thank you for joining us. Paul Chris says, are they doing conventional loans with a debt to income ratio of 43% or above? I know they tamped it back. I know it was as high as 50 last year, and then it seemed like they tamped it back to 45. What are they doing right now?
So again, depends on the lender that you're working with. A lot of lenders have tightened it up for sure, especially a lot of the bigger banks, the credit unions, things like that, depositories. We still allow up to 50, so you can still go up to 50%. So we have a system that we run, which is an underwriting system, and that system will tell us whether you can get qualified for above 43%. 43% is very low. I mean, I do them over 43% all the time. So that being said, we can definitely still get that done. Now, if your credit's not good, and you're only putting 5% down or 3% down, and your DTI is like at 48%, probably not going to happen. But if you are a buyer, 680 credit score or above, put 3% down, 5% down, you have a good credit history, no major derogatories, you should be fine to go above 43%.
So on that note, FHA, VA, USDA, what are the max DTIs currently? And by the way, Paul Chris, whenever he's saying he's referring to New American Funding. That's the lending company he works with. So when he's saying that, you may find a different answer from Chase, Wells Fargo, and everything else. What he's saying is that New American Funding, because they do service their own loans, in the vast majority of cases, probably upwards of like 97%, right? Then that's what they're able to do because they're their own service provider to the loan if they originated it. So that said, FHA, VA, USDA, max DTI, please. About
the same kind of deal. So different programs have different requirements. You started mentioning USDA, so you start talking about down payment assistance programs. Those are going to be capped typically at the lower 43%, 45% range. If you're talking straight FHA, VA, things like that, then we can go up to that amount. Sometimes we can even go higher if someone's got a lot of money in the bank. Outside of after they're closing, we can sometimes push above 50%. If you're closing on a $300,000 house and you've got 200 grand sitting in a 401k or, $80,000 sitting in a savings account, you might be able to push that a little bit more. It just depends on kind of the overall scenario. So now, again, that's with me. That's with New American Funding. Some of the bigger banks, some mortgage companies out there, even the smaller ones, they do have just a hard stop of nobody going over 43% because of this pandemic right now.
Okay. Hey, thank you for that. And I hope that answers the question, pal Chris. Hugo, my apologies to you. Bill Merren, being a lender, corrected me. And I am wrong. And I am one, if I'm wrong, they'll call a spade a spade. And if I happen to be a spade today and I'm wrong, I'm wrong. Said that the media would say that there would be potentially 50 to 60 million people unemployed in the near future. What will be the impact on real estate? I did, Bill sent me a quick message. Hey, dude, 330 million people are considered working in the United States, times 16%. And I just ran the number. It's 52,800,000 based upon what you just shared with us. So if we're at 16% unemployment presently times 330 million people in the labor force, then we're at 52,800,000 people that are potentially affected by unemployment right now. Now, that said, Hugo, I will share with you again. It's important to take in context how many of those 52,800,000 people are furloughed. And it would be a reasonable speculation until I can move beyond speculation into the world of fact, which is where I like to operate from with knowledge and comfort. And I rely on Bill very heavily whenever he gets information on this that isn't yet publicly available about how many people that are on unemployment right now that are realistically furloughed, because we saw this really sharp jump. And this is something I was chatting about with the husband and wife broker owners of one of the biggest brokerages in Miami-Dade, Florida, Denora and Jorge Guerra, a couple of weeks back, about the V curve and the different types of recessionary recovery types, because you're going to have a lot of industries that will operate very much like a V, where you have this sharp jump for the people that were laid off, let's say, or excuse me, furloughed in, let's say, the hospitality, restaurant businesses, bars and such, right? But then you're going to have a very sharp drop off as they return to work and they get off the unemployment roll. And that's where Bill is sharing with us really important mortgage rate news and mortgage news in general have to do as recently or as soon as this Wednesday with ADP's report and the BLS, the Bureau of Labor and Statistics report on May 8th with the unemployment rates and the jobs reports that come out. That's important information. Now, I'd ask everybody to keep it in perspective and to keep it in context based upon how many people are furloughed. That's realistically what I keep coming back to, because it's very important to understand. Is this a catastrophic number? Yes. Is there a lot of fear mongers, as Bill was sharing with us from Mr. Maxwell, fear pushers versus faith pushers, right? There's a lot of people out there that are doing click porn and porn in every sense of the word with fear. And that's nasty. It's gross. It's disgusting. And we got to go with the hashtag beyond fear, beyond false evidence appearing real movement that says, hey, let's take a step back here. Let's look at the facts. And Hugo, that's why, look, I wasn't doing the math quick enough. I was using a different number in my head. I was going off of like total American population. Bill quickly sent me a private message and said, hey, dude, you're wrong. I got no problem telling you if I'm wrong. That comes down to integrity and ownership and accountability. If I'm wrong, I'm wrong. And I don't mean to be wrong, but this is a live stream format and I'm glad that I was corrected. So Hugo, I did want to go back to you and share that with you, my friend, if you're still with us. So I definitely appreciate that. Bill, talking about private messages taking place during a live stream going back and forth. Bill, I gotcha. I heard you loud and clear, my friend, that you got to jump off. Really appreciate your support today and the tremendous amount of knowledge coming from you. In helping answer all these mortgage questions. Again, anyone, if you're local to Las Vegas or even around the country, and you're looking for a strong, solid loan officer to help you, please feel free to contact Bill. And if you have the opportunity to work with him personally, trust me, as somebody that has worked with him personally, not only in helping over 170 families buy or sell a home, but personally worked with him on my own personal residence. Let me tell you, love his process. Very, very tight. I knew exactly where I was every step of the way. And wow. So feel free to reach out to him. And even if he doesn't have the opportunity to work with you personally, I'm sure he can help you find a top loan officer near you. So Bill, again, thank you, my friend, for all of the wonderful information today. It's been great to have you.
Thanks, brother, man. Have a great day, dude.
You as well. Have a good one. All right. So I wanted to jump back to Tim here. And Tim, again, thanks. You were talking about inflation and unemployment and do I think it's a good idea to buy sooner or wait? Ultimately, Tim, it's the same thing that I've always shared with people with or without the pandemic. and what's going on. Number one, we got to look at, is it the right time in your life for the reasons that are important to you? Okay. That's one of the first questions we need to ask is why you're buying your home. How long do you plan to live there? And get very clear on your reasons why. That's always the first step. The second step is then to assess your job security position. And if you're concerned about a potential furlough or a potential layoff coming, then buy a home at this time. So, I mean, do not buy a home if you're concerned about job security or being furloughed. It's not the right time yet. Even if everything else in your life makes sense, please hold off and wait just to make sure that you're safe, because you need to have the ability to repay your loan. And we don't want to see you get hurt, Tim. Now, let's say that you're a medical professional. Let's say that you have strong employment and everything looks good and very secure in the future for your career path. Then, okay, going back to the reasons why it's important to you, right? And now addressing the job security situation. Then yes, if that's the right time in your life to make a move forward, then yes, there's definitely going to be some opportunities in the present market, especially with the low interest rates right now, historically low interest rates, to get the best of the interest rates possible at the time that you're buying. And given that there's this flux in the real estate market right now, as far as how many buyers are in the market they're able to buy, then you may find some sellers that might be a little bit more open-minded to giving some form of concessions, maybe a little bit towards buyer closing costs, or a little bit more generous in the repairs of stuff. So, I mean, it just depends, because every market realistically gets stratified by where it is, and then gets stratified again by the location within a city. Like here in Vegas, as you probably know, Tim, we have over 52 zip codes proper within the Las Vegas area, the greater Las Vegas area. That's 52 zip codes. So if we look at the Las Vegas market, we have a set of metrics. Then if we could break it down and go by zip code, we got a set of metrics. Then if we break it down by subdivision level, we got a set of metrics. But then the metrics get a little bit deeper when we start really assessing price point ranges and the competition and what's happening in those price segments based upon the median income of, let's say, Las Vegas in this case, right? Where are most buyers at in the market? Well, we find that most buyers in the Las Vegas market are under the $325,000 marker, yet the average price of a home in the Las Vegas market is approximately $280,000, $275,000. So that means that market is really, really hang on to your britches quick, like a roller coaster. So even in today's market, when we have dwindling inventory and we have people being impacted by furlough, there's still a lot of people that aren't. So that being said, when you take it into full context, then that market segment is extremely, extremely competitive, and sellers aren't having the budge. Those homes are going on the market, coming off the market. So it's important to take stock of that and just be real with that. So, okay, thank you for that update, Tim. I see that you said that you worked for CCSD for 16 years. Fantastic. Job security right there, working for the Clark County School District. So if you want to hit us up after the stream, then just feel free to reach out. Again, Bill's contact information and my contact information is in the description below. We've been streaming for about an hour, my friends, and we'll be back again on Wednesday. So I'll look forward to catching up with you guys then. In between now and then, please, I'm wishing everybody an amazing day full of love, joy, and hope. And please go out there and be the reason that somebody smiles today. Together, we are stronger, and together we can make the world a better place, one smile at a time. Enjoy a beautiful day, everyone.